It's that time again when CBS's 60 Minutes pretends to do financial journalism by asking coordinated, pre-planned, quote, hard-hitting questions, unquote, that their mostly aged and elderly television viewers have slim chance of critically thinking undisclosed holes through. We've covered other softball public relations pieces that 60 Minutes has produced on this SD Bullion channel. You might recall seeing a short video we produced in early 2020 entitled JPMorgan Silver Crime Charges to New York Fed Repo Loan Ramp. Since that video was published, JPMorgan Chase got off with a slap on the wrist fine by the Department of Justice and CFTC to the tune of less than $1 billion in value for supposedly spoof rigging precious metal prices thousands of instances of time over a more than decade time frame. If you missed that 17-minute expose, stay tuned to the end of this video for a click-through screen cap, or see the show notes below for a direct link on our website for the video. Hello out there, on behalf of SDBullion.com, this is James Anderson. If you'd like regularly published videos covering major news related to precious metals, do us a favor and hit the like button here. And also subscribe to our SD Bullion YouTube channel if you've not done so yet. As we often do on these For Posterity time capsule mockings, we'll highlight some legit financial journalism provided by WallStreetOnParade.com, a website owned and run by astute mom-and-pop Wall Street critics, Pam and Russ Martins, the former of which had a more than two-decade career on Wall Street herself. The following is their take on what they witnessed this past Sunday evening 60 Minutes CBS broadcast, which was shown on April 11, 2021. Their post, published the day after the 60 Minutes whitewash aired, is entitled, Fed Chair Jerome Powell Goes on 60 Minutes to present a false narrative on mega banks he supervises loaning out their balance sheets to hedge funds. The CBS's investigative, quote-unquote, program, 60 Minutes, gave Wall Street a pass again last night. This time around, 60 Minutes host Scott Pelley, seen here, interviewed Federal Reserve Chairman Jerome Powell. The Fed, and by extension Powell, are in charge of supervising the holding companies of the mega banks on Wall Street, including those involved just 2 weeks ago in loaning out their balance sheets to the tune of tens of billions of dollars to a hedge fund run by a man previously charged with insider trading and stock price manipulations. The man is Sung Kook, Bill Huang, and the hedge fund is Archegos Capital Management. Fed-supervised megabanks loaning out their balance sheets to hedge funds for nefarious purposes was previously exposed in 2014 in an all-in-depth report and hearing by the U.S. Senate's Permanent Subcommittee on Investigations. The practice has clearly metastasized since that time. The 60 Minutes interview comes just 2 weeks after Archegos blew itself up, along with generating billions of dollars in losses at mega banks that allow it to take on obscene levels of leverage in a replay of the financial crisis 2008, something that the Fed had continuously assured Americans could not happen again under its oversight. Rather than dig deep into the insidious rot of the Fed as lapdog regulator, Pelley devoted just a brief and shallow part of the interview to the topic of what happened at Archegos. The exchange went as follows.
A private hedge fund called Archegos collapsed last month after borrowing billions from banks to make risky bets on stocks. Now the banks are out billions of dollars. How concerned are you that the financial system is blundering into the same kind of opaque, risky bets that led to the Great Recession in 2008?
This is an event that we're monitoring very carefully and working with regulators here and around the world to understand. And I would say a couple of things. First, this incident doesn't really raise questions about the stability of the financial system or of those institutions, which are mostly foreign banks. What's concerning about it, though, is, and surprising, frankly, is that a single client of one of these large firms could result in such substantial losses to these large firms in a business that is generally thought to present relatively well understood risks. So that is surprising and concerning, and we're going to understand that and get to the bottom of it. What we try to do is make sure that the banks understand the risks that they're running and have systems in place to manage them. This would appear to be a significant shortfall, a failure on that front, and so that's something we're looking at.
Let's first focus on the preposterous statement by Powell, which goes unchallenged by Pelley that, quote, this incident doesn't really raise questions about the stability of the financial system or of those institutions which are mostly foreign banks, unquote. In reality, the incident goes to the very heart of the stability of the financial system in the U.S. It was the blowup of two of Bear Stearns' overleveraged hedge funds that took down the whole firm in March of 2008 and signaled the bigger rot in the U.S. financial system that would implode much of Wall Street by September of the same year, taking the U.S. economy with it and requiring a $29 trillion bailout by the Fed to resuscitate the casino banks. Secondly, the recent Archegos blowup is decidedly not about, quote, mostly foreign banks, unquote. That Powell would attempt to misinform the American people on this point strongly suggests this interview was a propaganda effort on the part of the Fed. Two of the banks intimately involved in the Archegos blowup are Goldman Sachs and Morgan Stanley. Both of these firms are U.S. banks and are supervised by the Fed. Both of these firms are allowed to own federally insured banks while also engaging in trillions of dollars of high-risk derivatives. And the hedge fund that was involved was created here in the United States, and the leverage was provided here in the United States, in complete violation of the Fed's own Regulation T, which limits initial margin loans to 50% of the value of the stock being purchased, not the 6-to-1 leverage or more that the banks provided to Archegos. We know that there are plenty more highly leveraged hedge funds out there being financed by U.S. banks because we're looking at SEC filings made by other U.S. hedge funds showing stock portfolios totaling hundreds of billions of dollars each. For example, Susquehanna International's most recent filings with the Securities and Exchange Commission shows that it had a stock portfolio with a market value of $612 billion as of December 31st, 2020. Citadel Advisors' latest filing for December 31st, 2020 shows a stock portfolio valued at $384.6 billion. And that's just two out of hundreds out there that are engaging in highly leveraged transactions with federally insured banks on Wall Street. A quick snapshot of just how seismic this problem was revealed in the most recent quarterly report by the Office of the Comptroller of the Currency. It shows that just one federally insured bank on Wall Street, JPMorgan Chase, had exposure to $2.65 trillion in notional equity stock derivatives as of December 31st, 2020. Notional means face amount. Later in the 60 Minutes interview, Powell provides more misleading information to Americans on the Fed's most recent bailout of Wall Street. The exchange went as follows. And you'd think the system, because of the oversight of the Fed, has the wherewithal to stand a significant shot to the markets. Jay Powell. Well, I think we saw that, actually. Yes, I do believe that. We never say that the mission is accomplished, but I would say that if you look at how the banking system and the financial system, most parts of the financial system, made it through quite a stress test last year when we lost, 25% of GDP and 30 million jobs in the space of a couple months. Now some parts of the financial system had to be bailed out again. These were really, though, non-bank places like money market funds and things like that, and where we had to step in again and provide liquidity. But ultimately, the work that we did in Dodd-Frank and in Basel to strengthen the banking system over the last decade, I think, showed up pretty well in what was a pretty good stress test. In fact, the bailout of Wall Street banks began on September 17, 2019, months before there was a reported case of COVID-19 anywhere in the world. By September 27, 2019, the Fed was offering $100 billion a day in emergency loans to Wall Street. By October 7, 2019, again months before any outbreak of COVID-19, the Fed had expanded its emergency overnight loans to announcing $310 billion in longer-term emergency loans as Wall Street announced over 68,000 in job cuts. By October 24, 2019, the Fed had upped its Wall Street bailout to $690 billion a week. And on it went, prior to any COVID-19 pandemic, which didn't come until 2020. We anticipated that the Fed would be engaging in this type of cover-up of the facts, so we created an archive of more than 100 articles we wrote documenting this pre-pandemic bailout by the Fed. You can read them in timeline order here, with documentation direct from the Fed itself. Congress, which was asleep at the switch in the lead-up of the epic financial collapse of 2008 and lulled into complacency by the lunatic musings of Fed Chair Alan Greenspan, can now listen to the false assurances of Fed Chair Jerome Powell, or it can perform its duty to the American people and rein in this out-of-control casino that has attached itself like a blood-sucking leech to federally insured banks that are backstopped by the U.S. taxpayer. This is also a good time to recall what Sandy Whale told John Reed was his motivation for wanting to combine his Wall Street trading houses with Reed's national bank, Citibank, in 1998.
He said, "John, we could be so rich."
It was this combination that forced Congress to repeal the 66-year-old Glass-Steagall Act in 1999 that barred stock speculating firms from merging with federally insured banks. Whale told Reed that his motivation for the deal was, quote, "We could be so rich," unquote, according to Reed in an interview with Bill Moyers. See Wall Street's casino banks, taking deposits from savers, in 1929 and today. And that was the blog of Pam and Russ Martins the day after Fed Chair Powell went on 60 Minutes to present a false narrative on mega banks that he supervises loaning out their balance sheets to hedge funds, 3 of which have imploded in recent year.
Archegos was able to invest only about 15% of its own money in all these stocks that it was buying, and that was made possible by the banks through something called total return swaps.
Those derivatives are already regulated, in effect. It's the kind of thing where we would expect those banks to know what they're doing. That's a fairly common instrument. We would expect banks to understand the risks that they're running. I think what really happened is that they did understand the risks that they were running. What they didn't understand was that this one investor was doing the same thing with 5 or 6 prime brokers around New York. And that when it came time to liquidate positions, it was 6 firms or so trying to liquidate positions. So there wasn't enough liquidity. So it was a risk management breakdown, and one that we're looking very carefully at to try to make sure it doesn't happen again.
One that you do not expect to see repeated.
I would say that we're determined to understand what happened and make sure that whatever happened doesn't happen again.
So there it is in so many words. There's basically no one watching over these commercial mega banks, leveraging up and gambling with FDIC-insured demand deposits. Remember, over half of all U.S. bank accounts are held within derivative gambling banks. So you should seriously consider your counterparty banks before the next largest ever implosion of Wall Street comes about yet again. Stay tuned to the end of this video to learn more about how they could legally take your money in the next bailout or bail-in session. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.